look now, but the problem bank list is edging higher. 63 banks in the first quarter from 54 in the fourth quarter of last year. The total assets of those banks up $16 billion. The total is $82 billion. So let's bring in Main Street Asset Management CIO Aaron Gibbs. And Aaron, obviously, these aren't high numbers, right? But the trend is moving up. You couple that with the reverse repo program, under $400 billion, and still some question marks about where banks are. How should we take the news? I mean, should we just sort of like, no big deal?
Well, certainly I think it's important to keep an eye on it. And I think there are only a very few advisors that are saying we should be getting into some of the regional and higher risk banks. I think that's still an area where if you're a little more risk averse, this is something you want to avoid. But overall, we do see very good strength in the larger banks. So I think it's really sort of at the smaller end and the sort of niche.
No contagion threat there, though.
I think right now it's very much controlled. We know that the larger U.S. banks are in some of their strongest financial positions ever, and these higher interest rates are actually making them more money. So I think it's for now, we're still in a safe place. So
speaking of higher interest rates, you also point out in your recent note that there is a large segment of consumers that have benefited from this as well.
Right. So on aggregate, the U.S. generally has more savings than debt. And so therefore, they're earning more money on that cash. This also greatly helps those Magnificent Seven. We know that those companies have huge amounts of cash reserves. They're earning more money. They're able to weather a greater storm. And that's, of course, the AI trend and just the media buzz helps those stocks, but also just simply their cash position, how profitable they are, helps them.
Speaking of consumers, though, on the other end of this, you're saying home builders. You're getting sell signals on home builders, and there are certain names that you would sell.
Right. So as we are looking at this, when you look at mortgage rates and inflation rates, because it does look like we're going to have somewhat stickier inflation for longer, this is any consumer durable. But in particular, because home builders have had such a huge run up since June 2022, this is a long-term uptrend. We're starting to see some weakness. I think these are some of the stocks that you want to take some profits out if you haven't already, like Lowe's and Masco. So I think these are some of your more vulnerable stocks going into the next quarter.
What about the materials sector? I'm overweight there. It felt like a no-brainer until recently. And some of these other, areas, industrials, some of these areas that felt like slam dunks for macro reasons, no longer acting like that. I mean, is that maybe, are they telling us something about the underlying economy?
I think so. I think ultimately we have been seeing some reports where there does seem to be some weakness, and particularly the ISM was very disappointing yesterday. So again, hurting industrials. And so it's really about, I think, going back to fundamentals. I know we are, much like your previous guest said, we are so controlled by macro headlines. But I think in order to weather out, let's say, the next 6 to 9 months, really focus on those fundamentals. There are going to be companies that come out of this ahead, and there are going to be those mismanaged companies that are the losers. And I think that's really what's going to push you going forward, rather than just doing pure sector bets.
All right. Great stuff.
Thank you.
Thanks. Always great seeing you. All right, folks, you heard it before.